a major bank just issued a warning. One of Bitcoin's biggest buyers has disappeared, and it is not who you think. Standard Chartered says corporate Bitcoin buying is over. The companies that were stacking Bitcoin aggressively, they are done. And that changes everything about where Bitcoin goes from here. Today, I am breaking down this report, what it means for price targets, why the $500,000 prediction just got pushed back, and whether you should be worried. Wall Street Lens. Let us dig in. Here is what Standard Chartered is saying. Jeff Kendrick is their head of digital asset research. He just released a note that is getting attention. The headline: corporate Bitcoin buying is likely over. These are not small companies. These are publicly listed firms called digital asset treasury companies, or DATs for short. Think strategy. Think the copycats that followed Michael Saylor's playbook. Companies buying Bitcoin and holding it on their balance sheet. Kendrick says the math no longer works for them. Quote, valuations no longer support further Bitcoin DAT expansion. End quote. The metric they use is called MNAV, market price to net asset value. When that number gets too high, it stops making sense to issue stock and buy more Bitcoin. That is where we are now. So what does this mean for price forecasts? Standard Chartered is making changes. They are lowering their year-end targets for 2026 through 2029. And their big prediction: Bitcoin reaching $500,000. That just got pushed back. From 2028 to 2030, 2 extra years. Kendrick explains why. Quote, future Bitcoin price increases will effectively be driven by one leg only, ETF buying, end quote. Before there were 2 engines, ETF inflows and corporate buyers. Now there is only one. One engine means slower acceleration. That is the logic. Let us talk about the recent price action. Bitcoin fell about 36% from its all-time high. That high was on October 6th. Investors are nervous. Some are calling it the start of a crypto winter. But Standard Chartered disagrees. Kendrick calls the decline, quote, painful but normal. He says this pullback fits historical patterns. Quote, the recent price action has been challenging, but the decline, while rapid, falls within normal expectations, end quote. So according to them, this is not a structural breakdown. This is just Bitcoin being Bitcoin. Now here is where it gets interesting. The timing of this peak has people talking. Bitcoin topped roughly 18 months after the April 2024 halving. That pattern has appeared in past cycles. It usually signals the start of a bear market. This has fueled the crypto winter narrative, but Standard Chartered rejects that view. Kendrick says the halving cycle is no longer the dominant force. Quote, we do not share the view that the halving cycle is still valid. Rather, we think longer-term ETF buyers are a much more important price driver, end quote. This is a major shift in thinking. For years, the halving was gospel. Every 4 years, supply gets cut. Price goes up. Standard Chartered is saying that framework is outdated. ETFs have changed the game, so if corporate buying is done, and the halving cycle is less relevant, what drives Bitcoin now? One word: ETFs. Kendrick is clear about this. All future price gains depend on ETFs inflows. That is the new reality. Is that a problem? It could be. ETF flows are not always consistent. We have seen weeks of outflows recently, billions leaving Bitcoin ETFs. If ETFs are the only buyer, and ETFs slow down, price stalls, or worse. That is the risk Standard Chartered is highlighting. But here is the thing. Standard Chartered is not bearish. They still believe Bitcoin reaches $500,000. Just on a longer timeline, Kendrick explains the thesis. Quote, portfolio optimization between Bitcoin and gold continues to show that global portfolios are underweight Bitcoin. Investment access and decision-making by investment committees take time, but we expect them to drive large Bitcoin gains eventually." End quote. Translation: institutions are still underallocated. The money is coming. It just takes longer than expected. This is not a crypto winter. Kendrick calls it, quote, "a cold breeze, uncomfortable but not deadly." Now, let me give you the other perspective, because Standard Chartered might be wrong. First, corporate buying may not be over. Strategy just bought almost $1 billion worth of Bitcoin last week. They show no signs of stopping. Other companies could follow. Second, new buyers could emerge. Sovereign wealth funds, pension funds, insurance companies. These players have not entered yet. When they do, the buying pressure could dwarf what we have seen from DATs. Third, the halving effect may just be delayed. Previous cycles took time to play out. We are only 18 months in. The real move could still be ahead. Standard Chartered is making assumptions. Assumptions can be wrong. So what is my take? Here is my honest view. Standard Chartered raises valid concerns. Corporate buying at current valuations is harder to justify. That is true. ETF dependency is a real risk. That is also true, but I think they are underestimating new demand sources. The Bitcoin story is not over. It is evolving. What I am watching: ETF flows over the next 3 months. If inflows resume strongly, the 500,000 target could come faster. If outflows continue, we may see more pain before the next rally. The key takeaway from this report: Bitcoin's path higher is still intact, but the pace may be slower than bulls hoped. Adjust expectations accordingly. That is my breakdown of Standard Chartered's warning. Corporate Bitcoin buyers have pulled back. ETFs are now the main driver. The $500,000 target just got pushed to 2030, but the bank still believes it happens. Not a crypto winter, just a cold breeze. What do you think? Is corporate buying really over? Or is this just a pause before the next wave? Drop your thoughts in the comments. You found this analysis helpful? Hit subscribe and turn on notifications. Wall Street Lens. See the market clearly. See you in the next one.